Welcome to Turning Point's Clearway Capital Solutions podcast series, where we talk to leading investment managers and general partners in their respective asset classes about the evolution of their markets and how they're responding to these changes. Established in 2008, Clearway Capital Solutions is an independent and privately owned company providing business development and capital advisory services to investment managers in alternative and traditional asset classes who are seeking to engage with Australian and New Zealand investors and their consultants. The Turning Points podcast series provides listeners with direct access to the insights of our investment partners.
Today we are joined by Vivek Tanneeru, Portfolio Manager from Matthews International Capital Management. Matthews is an independent, privately owned investment manager founded in 1991 in San Francisco on the belief that global emerging markets offer exceptional long-term growth potential. For over 30 years, Matthews has taken a long-term, active, fundamental investment approach to construct highly differentiated portfolios that focus on emerging markets, Asia and China. The firm manages assets on behalf of institutions, advisors and individual investors globally. Vivek, thanks for joining us today on Turning Points. Could you start by providing some historical background on Matthews and also yourself?
Hey, Michael, great to be with you today. I've been in the industry for about 20 years now, working across global equities and global emerging markets. I've been here at Matthews over 12 years. Now, Matthews is a bottom-up, long-only, long-term investor that emphasizes strong on-the-ground research. We are a high conviction and high active share investor too. We have over the years evolved to invest in emerging markets. We have over 3 decades of history of investing successfully through the cycles in Asia. And really, our move to EM was predicated by client demand our clients wanted to use our Asia expertise to access broader emerging markets, given that Asia has accounted for over 3/4 of the index weight within emerging markets. We have a very large investment team with over 25 members, all of whom focus on emerging markets in Asia. Our team members have about 10 years of experience on average at the firm and about 18 years of experience of investing in emerging markets in Asia on average. A lot of us, I'd say most of us, have been born, raised, studied or worked in the markets we invest in. At the firm, we speak well over a dozen dialects. And all of that background really helps us navigate our markets quite successfully, really knowing the cultures of the countries and the markets that we invest in. The other thing to note really is that our investment team is spread across San Francisco and Hong Kong offices. Finally, I'd say we take a lot of delight in sharing our knowledge of our markets with our prospects and clients. And that's something that we have done consistently and quite successfully throughout our history.
Vivek, we often hear about how emerging markets are under-researched compared to their developed market counterparts. And we're seeing mega large cap emerging market companies being well covered in the research community. Where are the opportunities to add alpha, do you think, in emerging markets? And how is Matthews structured to take advantage of that?
We do indeed see a lot of alpha generation opportunities across the breadth of emerging markets we look at. We take both a very broad and a very deep approach to generating alpha. One of the things that we have emphasized over the last 3 decades of investing in emerging markets in Asia is really the ability of small and mid-cap companies to be a great source of alpha. And to be successful at generating alpha in small and mid-cap space, you do need to have very deep research capabilities. Like I said before, we have over 25 investment team members who scour our markets for ideas. On average, we've done about 4,000 meetings a year for the last several years as an investment team. Again, going from places like Bangladesh, Vietnam, Romania, Turkey, all the way to slightly more developed parts of our universe in places like Taiwan and Korea. So the way we are structured is really to enable this deep dive research into the opportunities. And it might be worth noting that roughly half of our universe is not covered by any sell-side research. So given the legwork we do, not just talking to the companies we're invested in, but really talking to that broad-based supply chain and the ecosystems in which these companies operate, we are able to identify companies that are able to really attractively compound earnings over long periods of time. And given that we're able to be among the early investors in some of these companies, we are able to realize the upside from the re-rating that a lot of these companies see as more investors discover these stocks. And the way we are structured internally is to really be collaborative through what we call knowledge platforms. These are essentially either country or sector focused groups where people with common interest and expertise come together to research stocks and share insights about the economy and the sector, etc. On one hand, we have that extensive research footprint. On the other hand, we have a system in place which enables a wide sharing of those insights that we gather through our extensive research. So this is what really enables us to find stock ideas that are relatively undiscovered.
Matthews has traditionally offered client solutions that can cover a lot of ground style-wise, i.e. your high dividend portfolios, growth portfolios, and portfolios that are offering significant downside protection. Vivek, how would you describe Matthews' style as an investment house, and what are the common philosophical strands that bind the investment platform as a whole?
We are a long-term, bottom-up fundamental research house, while also being macro-aware. Some of the commonalities that you see across all of our portfolios, regardless of the style and the mandate, is that we are largely domestic consumption oriented, and we're also oriented towards high-quality companies. We emphasize governance, going back 30 years, as a way to protect our shareholders' capital and our own capital. And over the last decade or so, we have more formalized that as an ESG approach. In addition to, in the more recent years, we have added on a formal environmental and social focus on top of that historic governance focus to take a holistic view of our investee companies. And finally, there's a very strong risk management focus. I'd say those are the few common threads that run across all the Matthews strategies, regardless of the mandate.
The key holdings in typical Matthews emerging markets portfolio differ significantly from the index, as well as the mega large cap stocks that can typically dominate developed market portfolios. Is this a deliberate result or a byproduct of your bottom-up research, or a combination of the both?
I'd say it's a combination of both. The way that we have set ourselves up in terms of having a large investment team with very strong local expertise, with a very strong research footprint, really enables us to do deep dives into the markets we're investing in, and also at the same time be broad-based. And therefore, we've really relied on some of the undiscovered names or undercovered markets or undercovered investment teams as a way to generate alpha. We view emerging markets as being particularly conducive to generation of alpha, given the market inefficiencies that we observe. Uh, like we mentioned before, roughly half of the small cap universe, for example, is really not covered by any sell side analysts. So that does leave out a lot of alpha on the table, in our view, that can be exploited if one takes the right approach. So with that in mind, we have over a period of time developed this expertise in the mid end of the spectrum. And no matter what strategy one runs at Matthews, you're likely to see portfolio managers relying on this part of the market as a way to generate alpha.
Does the lack of overlap with non-Matthews emerging markets portfolios and the typically high active share mean risk control is an even more important facet in Matthews' investment process?
Absolutely. So we have strong risk management processes at three different levels, at the security level, at the portfolio level, and at the firm level. And we manage and monitor risk in two different ways. Firstly, at the investment team level, led by the portfolio managers and the CIO. And we also have an independent oversight being provided by our dedicated risk team and the compliance team. So talking about some of the things we do at the security level, we're constantly monitoring that our investment thesis continues to be valid through ongoing follow-up calls, not just with the companies we're invested in, but with the wider ecosystem in which these companies operate. There's a very strong emphasis on making sure that the governance standards and the broad ESG standards are being held up. And by generally being a fairly active shareholder that looks to engage companies on an ongoing basis. The portfolio level, we're very mindful of the active risk we're taking, the style tilts and the factor exposures that we're taking, and also being very, very focused on managing our liquidity risk, given that we operate in emerging markets.
Macro themes also tend to strongly impact emerging markets, particularly during times of heightened volatility. How does Matthews deal with that?
We are fundamentally a bottom-up investor, but having said that, we do very methodically and regularly monitor the macro risks that our stocks might be exposed to. So we do monitor macro variables on an ongoing basis. We are very mindful of the currency risk that we might be taking as a US dollar investor. And therefore, we monitor the movements there quite closely as well. But ultimately, the question we ask ourselves is what happens in the wider economy or economies that a given stock we're invested in operates, what kind of risk we are taking, when it comes to the earnings delivery. So that's the ultimate question we're trying to answer for ourselves.
How does liquidity, or the relative lack thereof, impact how you conduct fundamental research on emerging markets companies?
So we are really very focused on making sure that we're investing in the right business model, in the right management and the ownership team. Especially given some of the challenges that you mentioned, we want to make sure that we are able to provide liquidity to our shareholders if and when it's needed. And the best way to make sure that we're able to provide this liquidity is by making sure that we minimize the blow-ups in the portfolio. And the way to do that is really by continually underwriting the thesis and the management and the ownership teams that we choose to partner with. So that really is front and center of our focus. And we more formally also track statistics around liquidity at the stock level, at the country level, periodically as a way to make sure that we're managing our risk successfully. And one of the ways we ensure that we are partnering with the right business and the right management and ownership teams is really by spending a lot of time trying to understand the addressable market a given company is playing in, uh, how that's growing, and how a company we're looking at is positioned within that opportunity set, particularly focused on the share of profits a company can have within that addressable opportunity. And the way we check that we're partnering with the right set of people is really by doing very thorough channel checks, spanning competitors, suppliers, customers, regulators, and oftentimes non-governmental organizations in the geographies that a company we're invested in operates. So this is how we ensure that we are eliminating or mostly minimizing a blow-up risk.
What is Matthew's current view with regards to China? And how are these views reflected in your portfolios? For example, top down versus bottom up. And what are the big risks or events that can impact Matthew's view on China?
So, Michael, the beauty of Matthews is that there is no one view or a firm view. The portfolio managers have the freedom to have the right China exposure that best suits their mandates. But most of us believe that the macroeconomic risks are bottoming out in China, and that we're likely to see a stabilization and a gradual recovery from these levels. But we also think that geopolitical risks will remain elevated for the foreseeable future. The market price action over the last 3 months would support some of this view. For the strategies I run, the risk framework for China has two components. Firstly, it is to avoid flashpoint. So we look to stay away from geopolitical challenges, as well as challenges around human rights issues, etc. And the second piece of this is really embracing winners in parts of the market where the companies are not at the risk of geopolitical tensions, but will really benefit from China's effort to build its own supply chain. We're also focused on investing in companies that are aligned with Chinese policy and economic agenda, as this could provide a strong growth tailwind. Finally, we embrace private enterprises run by well-incentivized owners and managers. As regards to our views and potential future risks out of China, we do have a very well-seasoned and highly regarded China strategist and his team, and they are really particularly focused on monitoring the developments here. And we do not expect very dramatic escalation of these conflicts, but at the same time, our base case is that these geopolitical tensions are here to remain.
In conclusion, emerging market equities as an asset class has struggled relative to their developed market counterparts for a considerable period, which has seen some investors shun the asset class. Apart from relative valuations relying on standard metrics, what makes this asset class compelling going forward?
A few things to think of. Firstly, I think the growth differentials are narrowing. If you look at a long-term data series, you do see that narrowing or expanding growth differentials, the GDP growth differentials between developed countries and emerging markets countries, has a bearing on the relative valuations. Now, we've seen a 23-year low growth differential between emerging markets and developed markets in 2022, largely on the back of zero COVID policies in China. Now, given that that policy was lifted at the end of 2022, we expect to see a normalization, looking forward 2-3 years. That should really support stronger earnings growth in emerging markets and help the relative valuation differential narrow. I also think investors should think about diversification benefits that accrue by being invested in emerging markets. at a point of maximum performance differentiation compared to a developed world. To put things in perspective, MSCI US has outperformed MSCI Emerging Markets Index by 350 percentage points over the last 13 and a half years. So we do feel as growth differentials normalize and earnings growth comes back up as China normalizes, there is room for that performance differential to narrow and for EMs to do relatively better compared to DMs, developed markets, over the next 2 to 3 years. And finally, just remember that emerging markets are today home to the world's best, absolutely the world's best companies in areas such as semiconductors, electric vehicles, battery supply chain, renewable energy supply chain, and some of the world's best consumer franchises, as well as some of the best run financial companies in the world. So as a bottom-up stock picker, we're very focused on making sure we are able to invest in these companies that are able to compound shareholder wealth over the long term. I think for all those reasons, it might be a good time to be looking at emerging markets if one takes a longer term view.
Vivek, thanks for your insights, and thanks once again for joining us on Turning Points.
Oh, Michael, thanks for having me. It's been an absolute blast for me. Thank you.